Hi everyone, and welcome to this start of a new module on an introduction to the modern portfolio theory. In this particular module, we're going to discuss about the underpinnings essentially of what constitutes the modern portfolio theory, starting with the work of Harry Markowitz and developing then on to try and derive a couple of things about the modern portfolio theory. Just to recap, in the last module, we discussed investment decisions using expected utility. And we discussed the two main problems faced by an investor, which are the asset allocation problem and the security selection problem. We're going to delve more into that in this particular module. And thank you for being there for this particular journey with us. So, the modern portfolio theory actually explores the details of a similar portfolio choice under our last module, which was the mean variance expected utility hypothesis. And it explores this for an arbitrary number of risky investments, and that includes investments which could potentially be risky or risk-free. So um, in the modern portfolio theory, we need to be accustomed into what is the difference between this realized or the actual return, which already happened, and the expected return. So the realized return essentially is a return that already transpired, and it's the return for some previous period of time. So it's an ex post return, right? And it is essentially we define the end of period return on a particular stock I, assuming that there are no dividends. So in most examples throughout the modern portfolio theory, we'll assume no dividends. And PI naught, this one, is your current price per share, right? Price per share. And then you have here PI. This is your end of single period price. So end of single period price, and you get the return, which is RI, right? Now, if there are dividends, so if dividends are paid during the investment period, then the realized return on a particular stock is just essentially this one plus the DI term that you have here, wherein DIs are your dividends distributed during that period. But while this is an important concept to learn, we're mostly going to be dealing with expected return as we have before. So let's recall what is expected return. Well, expected return more formally is an anticipated return for some future period of time. It's an ex ante return. So for an investment in a particular risky asset, a realized return may be more or less than what was expected. So for example, you made some investment, say of $5 or 5 pesos, depending on the state of the world, say 1 and 2, that could be 10 pesos or that could be 3 pesos, right? So it could be more or less than the initial value when they initiated the investment. Now, for risky assets, the best that can be done is to assign probabilities to various possible outcomes or to various states of the world. Say that we know the discrete probability distribution of P sub I, then the best estimate of the end of period price per share below is just this PS term that we have here. So it's that PS term, okay, which defines the probability of a particular state of nature, and we have PIS, which is the end of period price. So it's what's that expected price times the probability of that expected price occurring, and we sum it all up. So if you just try and rearrange the formula, you can get this derivation of the expected return, which is that mu I there, right? That's just 1 over PI naught times the expected value of PI minus 1. So if you know the discrete probability distribution of the return PI or the end of period price of the stock, then we can estimate the return on stock I for each state RIS using that form below. So if you look at this particular slide here, say that the current price of a stock is 10 pesos or $10, then you have here your states of nature. So states of nature. So you have your state of nature 1, 2, 3, 4, 5. Each state of nature has a likelihood of occurring. That's the probability that you have there. And each state of nature has an associated end of period price. So if I'm in state of nature 1, then my end of period price is 8. If I'm in state of nature 2, then my end of period price is 10. If I'm in state of nature 3, that's 11, 4, that's 12, 5, that's 13. And what we do is we sort of use these end of period prices and we express them. So we express in terms of rate of return. And that's what we have here. So this 8 peso return from the 10 peso investment, that's a reduction of minus 20%. The 10 peso return on a 10 peso investment, that's a 0% rate of return, and so on. Then we just apply the formula to get the expected return, and that's just 1 over PI naught. PI naught is the initial or the current price of the stock, which is 10, times the expected value of PI. So all you need to do is you need to just add these things up, add these things, and then divide it by, we have 1, 2, 3, 4, 5. We divide by 5, you get 10.9 minus 1, and you get 9%. So your expected rate of return is a 9% thing. Okay, so that's our conclusion there. So a key concept in the modern portfolio theory is essentially measuring the risk of a particular asset. And risk is the chance that the expected return on an asset will be different from its risk is the chance that the return on an asset will be different from its expected return. So take that out. So we have two types of assets based on their riskiness. We have a risk-free asset, which by the name itself has zero risk effectively. And typical examples are like T-bills with some maturity as investors' holding period. And we also have risky assets like stocks and certain corporate bonds. So these things are so oftentimes riskier investments. You also have other mutual funds could be risky assets and so on. And risk is often associated with the dispersion of the likely outcomes. And dispersion refers to a great deal of variability. So since we know that risk has something to do with variability, we also obviously need to talk about the variance of the returns. So the variance of the returns on an asset I is a measure of the risk of an asset. So the higher the variance, generally the greater the risk. So of course you want a low variance as much as possible. So say that you were given with this return here, then we can express the formula of the variance as being equal to this by just using the properties of the variance you've learned in basic statistics. And note that I think most people would be more familiar with this definition of the variance, which is more conventional in statistics notation, which is your raw minus the mean squared times the probability. So that's how you would be getting the variance in that way. So there are a couple immediate conclusions that we can sort of pinpoint from this analysis of expected return and risk, right? So the expected return on a portfolio P is essentially the weighted average of the expected returns of the individual assets comprising the portfolio. Remember, it's obvious that it's kind of rational to think that in a portfolio, you would have many different types of assets, and each asset would have a specific weight. When we mean weight, we mean the amount it corresponds as a proportion to the whole investable wealth. So you might have a larger weight in riskier assets than in risk-free assets. You might have a larger weight on stocks compared to, say, mutual funds and other things. So those are weights that you have there. And the expected return is essentially the weighted average of the returns of each of those asset classes. The variance of the portfolio's return is generally smaller than the weighted average of the variances of the individual assets returns included in the portfolio. And this particular conclusion stems from the fact that this is likely due to diversification. So if a typical person were going to build a portfolio, the portfolio would likely not just be one single asset class. Rather, he or she would try to include multiple asset classes, which are generally unrelated, such that if one market falls, the other one is not that much affected or not affected at all. So that's diversification, which we will talk about in another video. And as before, a typical investor's objective is to maximize expected utility as a function of portfolio expected return and variance, which is that which we formulated in the last video. So That's it for this video. In the next video, we're going to discuss the underpinnings of the Markowitz model, something crucial into understanding our concept of the modern portfolio theory. So thank you for your attention. Thank you very much for standing by, and I'll see you in the next video. Thank you very much.